Good morning and welcome to today's 5 with Fitz. I'm Keith Fitz-Gerald. Let's get to it. The markets were down on some minor profit taking early this morning, but have since gone green as traders try to get ahead of whatever trade deals are apparently in the works. Now that makes all kinds of sense when you think about it, and something I call Keith's rule of the back page applies here. The biggest, best, and potentially most profitable stories are almost always found on the back page where very few people are reading along. So here's my playbook. Number one, when the housing market cools, the tool belt heats up. Now, let me explain what I mean by that. March home sales just dropped to the slowest March pace since 2009. Now, this might, an emphasis on just might, be the start of something bigger. So you can queue up a potential tailwind for home improvement names like Home Depot and Lowe's. Now, I say that because I think there's a case to be made that both companies could quietly outperform over the next few months, even as broader housing headlines stay chilly. Think about it. The housing market might be stuck right now, but household wealth in real estate continues to rise. Every 1% in home prices translates to roughly $500 billion on the household balance sheet, according to the Fed's reserve flow of funds. Now, that suggests that hammers are swinging, tiles are being replaced, and kitchens are getting that long overdue facelift, especially with property values holding, and especially in regions where growth is still strong, like the Rocky Mountains, for example. So Keith's investing tip for this one is, again, you follow the money behind the headlines. On the back page, when the real estate market freezes, renovation retail can heat up fast. But will it is another question entirely. Number two today, what I'm watching with regard to Google and Alphabet. Google just told some remote employees, hey, come back to the office 3 days a week or your job's at risk. Imagine that. The company is tightening its hybrid policies as it slashes costs and doubles down on AI infrastructure. Now, I'm not surprised, and you probably shouldn't be either. Innovation requires in-person collaboration, says me, probably says you, and definitely says Google. It makes sense, and it's right out of the Jamie Dimon playbook. AI is expensive and overhead is under the knife. And it doesn't matter what company you're talking about. This isn't about cubicles like most people will think. It's about capital discipline, and badly needed capital discipline at that. Now, will I touch the stock? Will I buy Alphabet? That's the question I get a lot. And the answer is still nope. Google is still struggling, and it's a me too at best when it comes to AI, chips, data, advertising, and more. A comment that will no doubt have scores of Googleites rolling their eyeballs. But before you get after me or hit the keyboard, take a look at the data. Google has trailed peers, Google Alphabet, I still gotta call it Google. Google's trailed peers in the broader market for a long time. If you don't believe me, again, I get that a lot. But do the numbers. Every $1,000 invested in Google 5 years ago would be worth $2,521.30 today. The S&P 500 over the same time frame, $1,945.10. In other words, you would have had an extra $576.20 by investing in Google. Now, call me crazy, but that is hardly awe-inspiring, especially for a big tech name like Google. Nvidia, on the other hand, would have turned that same $1,000 over the same time period into $14,875.20. What is that? $14,875.20. Yep. That's a 6x gap in wealth creation, if I'm doing the math in my head correctly. Anyway, Google reports later today, and I will be watching carefully for signs that I am off base or entirely wrong. And frankly, I would like to be both of those things, off base and wrong. But I don't think I am, because Google faces a mountain of legal challenges, including advertising-related monopoly claims, illegal and predatory behavior, none of which is good. I'm also going to be watching comments about AI and search very, very carefully. Google reminds me of Kodak, which actually pioneered digital photography, something not a lot of people know, but they didn't release it because the company feared it would cannibalize its film business. Think about that one for a second. And finally, Google faces multi-billion-dollar hit potentially from advertising as tariffs bite and Chinese advertisers pull back. So what I'm wondering is not, is it time to buy Google, but is it time to buy some putskis, meaning a bet that the stock goes down? Catch up is not a strategy. It's not an investment strategy anyway, and you don't want to confuse cost cutting with leadership. So the tip here is always buy the best and ignore the rest. And be flexible in case you need to adjust your thinking. And I may have to. Number 3, dividend investors, beware. Pepsi missed on earnings, beat on revenue, but still cut its full year outlook, citing tariffs, big surprise, economic volatility, and soft North American demand. Imagine that. Shares are down this morning, which means anybody who paid attention to my remarks just yesterday may well have a big Cheshire grin on their face, hopefully including you. Now, it's no big mystery why. Volume fell across snacks and beverages. CEO Ramon Laguarta warning of more uncertainty ahead. Turns out, even the U.S. consumer, the company's bread and butter for decades, is showing fatigue. Now, Pepsi has been a name I've owned in the past, but it's not one I'm keen to own at the present, given what I think will be a very expensive reformulation headwind for snacks, sugary drinks, and more. As a result of reformulation requirements from the new FDA, drug, food additives, chemicals, all the stuff that's been put into our food in the name of profits and food science. I think dividend investors, for whom Pepsi has long been a favorite, might be in for a rude awakening, so pay very careful attention. I hope not, but I would be remiss not to mention the possibility. Give it a quarter or 3. Meanwhile, consider investing in dividend alternatives with far higher TSY, true shareholder yield. The markets are not facing challenges that Pepsi does. Now, I write about companies like this in One Bar Ahead, our paid research, and if that's helpful, I'd love to have you on board. You can learn more by clicking in your email today. Number 4, I love this, but it's interesting. Betting on the little guy in Japan. Japan's Tokyo Stock Exchange is slashing the minimum investment threshold, some from 500,000 yen, about $3,500, to just 100,000 yen, or somewhere in the name of $500 to $1,000, to coax retail investors off the sidelines. Now the goal is to reignite a market long haunted by the ghosts of the 1990s bubble, something I lived through personally while I was in Japan. It's a big shift. And for decades, here's why this is a big deal. For decades, Japanese households saw stock investing as gambling. And now, with pension gaps growing and younger generations less risk averse, Japanese stock exchange and Japan in general is betting on retail demand as the next growth engine. Will it work? Unfortunately, I doubt it. I spent 35 plus years deeply involved in Japan as a resident, a businessman, a husband, a father, a son. I care about what happens there on a profoundly personal level because I love the place. Here's the challenge. The very things that once made Japan formidable, discipline, hierarchy, and tradition, are now its Achilles heel. Decades of corporate rigidity, cultural resistance to change are exactly why Japan may never, that's a big word, never reclaim its former global dominance. Even Warren Buffett's recent Japanese plays aren't really about Japan. Let's be honest, what he's doing over there is probably a currency trade. Buffett is very likely playing some level of high-level currency or debt arbitrage, and he may even be using his Japanese investments to wash parts of his portfolio. Buffett's always been a master at interest rate differentials, so this could be a case where he's borrowing in yen at dirt cheap rates to finance his stake, effectively creating what's called a carry trade that earns him more in dividends than he pays in interest. The other possibility, seems to me, is that he's layering in Japanese trading companies to add as a proxy for industrials, commodities, and global trade without having to dump his U.S. holdings. Now, this, if it's true, would simultaneously de-risk his holdings and boost his cash flow without the need for a complete reset. No doubt Uncle Warren has his reasons, but this move, a hard pass, or in Japanese, enryo shitoku. My investing tip here is that culture eats policy for breakfast. Changes on paper mean nothing, squat, unless they're backed by deep behavioral shifts, particularly in a country like Japan, which is bound by centuries of tradition. The trade idea is very simple. Watch Japanese retail trading platforms and ETFs like EWJ. If retail and interest picks up, volumes could jump, and that means short-term momentum for savvy traders. Longer term, not so much for investors, unless you're at Buffett's level. And finally, number 5 today, rebalancing roulette. Is this the next big buy signal? Norges Bank, which is the heavyweight behind the world's largest sovereign wealth fund, just took a $40 billion gut punch in Q1 thanks to tanking tech and ugly currency shifts. Meta, Nvidia, Alphabet, Tesla, many of the names we talk about regularly led the charge down the hill in the wrong direction. Now here's the kicker. If I have my data right, about 70% of the fund is parked in equities. And since these big boys don't trade like you and I would or a real trader would trade, they'll likely rebalance and hard. That means the same mega caps that just crushed them could be back on the buy list almost immediately as the fund's investment committee scrambles to restore balance. Now, you talk about a potential tailwind. This is a big one, and it's also classic. It's something I wish more individual investors understood and did. Norge, by the way, isn't the only fund in this position. So here's the thing to think about from an investing perspective. My tip, really. Rebalancing isn't just housekeeping like people think. It's profit seeking in disguise, which is why you want to do it, especially when losses are on the table, which is why I encourage every investor to think about it and, again, do it regularly. Trade idea here is dirt simple. Well, keep it simple, stupid simple anyway. Keep your eyes on beaten down leaders, especially in the ETF, the tech-laden Mag 7 that I mentioned the other day. If the big dogs are buying, and Norge might be, a bounce in mega caps might not just be possible, it might be policy. Bottom line today is get rid of your biases, especially when it comes to the stock market. You will be amazed at how clear things come and how fast profits follow. As always, make it a great day. Thanks for spending a few minutes of your time with me. You got this, I promise, and I'll see you tomorrow.